we're talking specifically about tanker and LPG financing. We have Vafias, CEO of Stealthgas, who in 2008 was recognized by NASDAQ as being the youngest CEO of a listed shipping company worldwide. And he became CEO of Vafias Group in 2007, actually, the year before that. And today, the Vafias Group is the fourth largest shipping group in Greece, with over 70 owned vessels. And that includes Stealthgas, the largest owner of LPG ships worldwide. So, Harry.
Thank you very much. I'm going to talk about the shipping market and financing overview. Some of the things I'll be talking about were already said by the previous speakers, but hopefully I'll add a couple of new things for you. Everybody knows we have the worst shipping market since the 80s. Too many ships, coupled with huge bunker costs. And unfortunately for the ship owners, European banks, up to now at least, up to last year, made up of 90% of all ship finance. What are the main problems for the banks? We have some temporary problems. What are the temporary ones? The majority of the balance sheets have been affected. There's a shortage of dollar funding, and we have a couple of structural changes, which is the Basel III and the Solvency II, which is a directive to harmonize EU insurance regulation. These two are here for stay. The other ones, we'll see if they're going to stay for long or not. Banks have been required to strengthen their capital positions by building a capital buffer against sovereign debt exposures. Banks are also required to get their Tier 1 capital ratio to minimum 9%, and this had to be implemented by June 2012, so 5 months ago. The order book stood at 271 billion in 2011, and with the additional ships that have been ordered recently, this has risen by at least another 10%. The current fleet in the water is valued at approximately 841 billion, and the total bank loan portfolios is today in the region again of 550 billion. However, the liquidity need is softened by cancellations of new buildings, slippage in the delivery dates, the entrance of private equity players, and also the slower entrance of Chinese banks in financing of European owners, and maybe in a smaller degree US banks. The annual global volume for the syndicated market for all the industries, not only shipping, is $4.5 trillion. After the 2009 crisis, syndicated loan volumes fell to about 2 trillion. That's a huge decline. In shipping, first half 2012, we've seen a 52% decline to about 17 billion. And on an annual basis, total loan volume for 2012 will fall to 34.5 billion, or in other words, a 50% reduction compared to 2011. In other words, these levels are approaching 2009 levels. This is the list with the top 10 book runners and top 10 mandated leader ranges. As you see, DNB is leading both in both tables, followed closely by Mitsubishi, Nordea, and then Citibank. The Eurozone crisis has left all the periphery countries with huge funding costs, about 250% more than the pre-crisis levels. We have a combination of too many ships coupled with very low freight rates, which obviously chokes the shipping companies and obviously their banks. So as Franz said before, the banks stop lending or lend only to a handful of loyal customers, which is obviously the opposite of what the owners would like, because obviously counter-cyclical financing is much better than financing at the peak, but unfortunately only a small amount of banks do follow this rule. So pricing for ship financing, also Franz spoke about that. So obviously stronger balance sheets are required, advance ratios are falling, loan margins are going up considerably, and obviously, as we discussed before, tenors and profiles have shortened, and that's only for the strong shipping companies. Unfortunately, for the smaller ones or those with a weak balance sheet, these loans are not even available, even at much higher levels. Why the LPG space is different? It's quite simple actually. We have a much smaller order book, as you can see. It's less competitive, it's less fragmented, therefore fewer players, generally stronger, more established companies, the majority of which are considered industrial companies. Another advantage is the charters are in general terms more serious. You don't see the way the dry bulk charters, for example, have acted during the crisis with renegotiations and non-payment and so on. In the LPG sector, the majority of the charters are either subsidiaries of the oil majors or national oil companies. You have less volatility in the freight rates, which again is a big difference. To give you an example, at least in my segment, the freight rates vary between the bottom and the peak with only $6,000, whereas for an Aframax, for example, the same volatility, the same variation might be $50,000. And also there are very good fundamentals coming in the next few years due to LNG. There's a lot of new LNG projects coming online, and as you might know, LPG is a byproduct of LNG and also a byproduct of crude oil refining. Therefore, because of these fundamentals, it's quite a special segment, at least for now, and that's why at least we've seen the banks being willing to lend money to us, obviously at more expensive levels, but they're far more keen than, for example, for one of our dry bulk or tanker projects. Thank you very much and enjoy the rest of the conference.